Are you invested too conservatively for retirement, or did you even know that was possible? Well, today we're going to walk through a case study of a couple that's 64 and 62 with around $1 million saved for retirement. And I want to walk through and show you, hey, they're too conservative in how they're investing their money, and they're going to have to take a little bit of risk ultimately to help their retirement plan succeed. But first, hey, if I haven't met you yet, my name is Jacob Duke. I'm a certified financial planner, and the purpose of this channel is to help you succeed in retirement. So when most people get close to retirement age, their first and natural instinct is to get really conservative and pull back how much they're investing in stocks. And this is a natural thing, so I totally understand why, because you've worked your entire life, you've saved as much as you can, and you've invested well. And whenever the market goes down 10% or 20%, you don't like watching your account balances fluctuate. I totally get it. It's a normal reaction. But what if I told you that having equities in your portfolio is actually a necessary risk that has to be taken to ultimately combat inflation over time? Because if you don't have the equities in your portfolio beating inflation throughout your retirement, you're ultimately going to get to that place of maybe running out of money, which is the worst thing that could happen to you. So right here, we can see that Brad is age 64, Tina is age 62, so there's a 2-year age gap. And we're saying for now that Brad is going to live until age 85, and we're going to say that Tina is living until age 90. So that's where they stand in terms of their ages. And here's where they are in regards to their overall net worth and where those assets are held. We can see that the majority of their net worth is in Brad's IRA, which is $700,000. That's the current balance on it. We can see that Tina's IRA is $250,000, and they have a joint checking account with $60,000 cash. And also a big part of this, they have a primary home that's worth $400,000, which is completely paid off, which is a great job by them to have all of their debts paid off at this point. Now, whenever we look at their goals in terms of what they're trying to accomplish and what they need to spend in retirement, number one, they want to retire right now. So at age 64 and 62, by the start of 2024, they want to be retired. So that's their goal. And whenever they get to retirement, their ultimate, how much they think they're going to spend is around $5,000 per month based on their current spending. Remember, all debts are paid off. So being able to spend $5,000 a month is what they would like to do. Also, I've got their healthcare insurance premiums and ultimately Medicare cost factors in as well. So we can see right now, being under age 65, they can't qualify for Medicare. So right now I've got them factored in at about $1,000 a month on their premiums for each of them. So $12,000 times 2, $24,000 per year is what we're expecting to spend on healthcare premiums those first couple of years until they get to Medicare age. Also, once they get to Medicare age, I've got them factored in to actually be starting Medigap and on top of their Part B and Part D premiums. So I've got that factored in at $3,400 per year as well. So that's where they stand in regards to healthcare right now. We're not going to put a travel budget in there. They think they can travel on that full $5,000 per month, but we'll end up seeing how that goes. In terms of their income, Brad has been making $80,000. Tina has been making $54,000. Those are going to obviously stop whenever they begin their retirement. Now for Social Security, we can see that Brad's Social Security estimate at full retirement age, which for him is 66 and 10 months, is going to be $2,800 per month. But for now, they're saying they want to take that benefit as soon as they retire and begin getting a stable income stream. So we've got him electing his Social Security benefits at 64 at the beginning of his retirement. Tina's benefits at full retirement age, which for her would be 67, is going to be $2,400 per month. But remember, right now we're taking hers at 62, which is the start of her retirement as well. So neither of them are delaying their Social Security until full retirement age. So that's where we're standing in regards to their ages, how much income they're going to have in retirement. Now let's take a look at their overall investment portfolio for their two different IRAs. So Brad's has $700,000 in it. We're basing this, based on their request anyway, to have 100% bonds and cash in that particular account. So no equities, no stocks, no real estate, nothing else, just bonds and cash. They want this to be the most stable portfolio they can have. Also, we've got Tina's invested the same way. We've got that invested with 100% bonds and cash as well. So that's where we're at in regards to their overall investment allocations. Now, I wanted to give you a little bit of detail on some of the assumptions that we're making here in this particular plan. So right here, we can see their investment allocation of 100% bonds and cash. That's what this this ultimately gives them, they have 0% in equities, none in international equities, no emerging markets, no real estate. They've got 60% of their dollars invested in US bonds. They've got 10% international bonds, and the other 30% is in cash like CDs or money markets. So that's where their overall portfolio is going to be invested, 100% bonds and cash. That's what they want at least. Now, a couple other things I wanted to show you that we're going to be able to play around with here in a second is what happens if different market events happen. So for example, we could have a really bad decade followed by really slow growth. So what does that do? And we're going to see this here in a minute on their plan. We're going to see how that negatively affects them. So we see a really bad decade followed by really slow growth. That's going to happen moving forward. Also, we can see that what if they have a really strong growth scenario in the stock market? What if we have a good 10 years and then followed by slow and steady good growth? That's another scenario we can run through. Also, what happens if all the stock, bond, cash returns over time end up being a 0% average? What does that give us? We're going to look at that as well. And then also, a lot of times people are curious about sequence of return risk. So I built this bad first 2 years model to show you what happens if the market goes down, the stock market goes down 20% the first 2 years. Where does that put us by the end of the plan? And does that really negatively affect us? So we're going to look at that as well. Also wanted to show you some assumptions that we've got. I'm just going to scroll through. These are the different investment asset class assumptions in terms of dividends or capital gains or returns. So I'm just going to scroll down. I'm not going to pause and go through this. You can stop the video and check that out if you want to. But the thing I did want to show you is that inflation, I've got that factored in at 3%. So that's going to be the average we expect over the life of their plan. And then also the other thing I wanted to show you is that their Social Security inflation or cost of living adjustments are going to be factored in at 2.5% on average. So those are the important things to know in regards to the different assumptions we're going to make. So let's go ahead and take a look at their plan and see how they're going to do. All right, so right here you can see that based on their current assumptions of we want to have 100% bonds and cash, we want to take $5,000 a month, take Social Security immediately upon retirement, that leaves them with a 14% overall success rate based on this Monte Carlo. So you can see the different assumptions here and all the different levers we can pull, and we're going to start pulling some of these to see what actually gives them the best outcome. So one of the things that they mentioned to me was, Jacob, we just cannot stomach any market volatility because we want stable income. We don't want our money going up or down at all throughout our retirement. And while that might be a hopeful thing in terms of we're not losing money in the stock market, what we're going to see here in just a second is that some risk is necessary. So one of the first things I wanted to look at with you is what if we delayed their Social Security at all to maybe full retirement age or perhaps even 70? Do those have positive or negative impacts? So we're going to keep everything else the same. They're still retiring today with $5,000 of expenses. What if we change their Social Security elections to be full retirement age for both of them? How does that impact their plan? So it actually really impacts their plan. And what happens here is they're not necessarily living and having more money at the end of the day. It actually increases their probability of success because they're going to have a more stable and higher stable income throughout their life of retirement once they turn Social Security on. So we can look at this really quickly. So their cash flows, whenever we look at the summary on this, we can see based on their current plan, okay, we can see beginning in 2024, which is the first year that they would have their Social Security coming in, at least for the full year, we can see Brad's benefit would be around $27,000, Tina's would be $20,000. But what if we went to the proposed plan of delaying it past 64 and past 62 all the way to their full retirement ages? They're not going to have any income from these in the first couple of years, but once they get down here to, let's say, age 67 for Brad, he's going to have higher than 28,000. Let's see what that comes out to be. Yep, so right here, I guess it's 68. Yeah, so it went from 28 all the way to 36 for him. Now let's see what happens here at age 68 for Tina. So with it being full retirement ages whenever she takes it at 67, we're gonna see $32,000 per year there. What if we change that back to the current plan of her taking it at 62? How much per year difference does that have for her? So 32,000 all the way down to $22,000, so a $10,000 per year difference just by taking it 5 years earlier. So whenever we go back and we can say, hey, how did this increase from 14% all the way to 71%? Well, the probability of success is going up because they have a higher stable income for the rest of their lives. Now, obviously that's gonna change a little bit if they pass away early, or if they pass away later, obviously delaying it is gonna be more beneficial. But if they happen to pass away earlier, there could be a little break-even point where it may have made sense to take their Social Security at the earliest possible age. So I'm going to change this back really quickly because this is what they want to do. So we're going to keep the current strategy of taking their Social Security at 64 and 62. Now, what if we start playing with the investment allocation a little bit to say, what if we don't have 100% bonds and cash? What if we added some equities or stocks to that? So I'm going to increase this slowly from current allocation, which is that bond allocation. And we're going to go to 20% stocks and see, does that improve our situation, still taking $5,000 a month in terms of how much we have to spend on expenses? Once again, it increases it, so it's almost like a wash between delaying Social Security to full retirement age, or we can do 20% stocks in our portfolio. So that changes it to around 77%. I think it was 74 maybe for the other one. But regardless, it's about the same increase in terms of the probabilities of success. And remember, that's still factoring in $5,000 per month in expenses. So what if we keep going here? I wonder if we go to 40% stock, does that improve it even farther? Okay, it does increase it all the way to 89%, but one of the things to look at is the dollar amount they would be passing away with. So in some sense, if they invest 40% stocks and they have leftover money at the end of the day, that means they didn't spend enough along the way. So what if we change that from 5,000 all the way to 5,500? Does that improve the plan, and is it still possible to do this? It sure is. So you see the overall probability of success go down, and it has to do with sequence of return risk, which we can look at in just a second, but they're still going to have more money at the end of the plan if they elect to do 40% stocks as opposed to 14%. So whenever we look at the confidence here, we can see based on the proposed plan, there's a lot wider variation of possibilities here. They could have a lot more at the end of life, or they could run out of money sooner depending on market returns at the time. So let's take a look at this with some of these different comparisons. So right now, based on a baseline expected return on that 40% stock allocation, we can see they're going to have more money at the end of the life of their plan. But what happens if they have a really bad decade followed by some slow growth in the stock market? Well, we can see that the optimal plan is to have the 100% bonds and cash because they're going to run out of money sooner with that new proposed plan of being a really bad decade followed by some slow growth. Now, what happens if they have a strong growth scenario? Well, they're obviously going to have more money in that situation if they do it that way. But what happens if they have a flat return of 0% over time? We can see that still bonds are going to be better because a 0% return is worse than only a 2, 3, or 4% return. And then what happens here with the sequence of return risk issue that we have of the first 2 years being really bad in retirement from a stock market perspective, and then have decent or regular growth after that. So we can see on the green portion, we can see a straight down drop because we're having to pull money from the account and we're having to withstand some of those 20% downturns in those first 2 years. And then after that, the market starts going back up over time. So that's on a 40% allocation. Now, what happens if we change this to 70%? I'm just curious what happens here. So you actually end up with a little bit more money at the end of the plan, but those first 2 years hurt a little bit worse because you're going to be investing 70% of your dollars in stocks and the other 30% can be in bonds and cash. But after that, if you remain and hold on to that 70% stock allocation, whenever you hit the growth again, these years from 66 on, that's whenever you have the opportunity to have more money in the later years. So let's take a look really quickly and see what happens if we have a 50% stock allocation. We're still living on $5,500 a month. Remember, we increased that by $500. We're still taking Social Security early, and that's about break even. Now, if we only do the 100% bond allocation and we still try to take $5,500 a month, it's not going to work. Yep, so that's a lot less, right? So we have to have, if we're going to increase our spending or increase our expenses at all, we've got to have some stocks in the portfolio. So we can see here that based on a normal market cycle, they're going to have a lot more money at the end of their plan if they include 50% stocks and then also delay their Social Security until full retirement age, which also gives them the opportunity to take more money in retirement and live on and enjoy. Let's see also what happens if they increase this all the way to $6,000, so increase it a whole $1,000 per month. They're still good to go based on a normal market cycle. So let's see what happens in a strong growth. Obviously, they'd have more money to live on at that point. So bad first 2 years, it would obviously hurt them a little bit, but if this event happens, there would have to be adjustments made. So if that event happens, we can no longer live on $6,000 a month. What if we did $5,000 a month and pulled that back? Wonder if that helps us out. And it sure does. So some of the flexibility around, depending on how the markets are going and what's going on in your accounts, you can actually tweak things and pull back on how much you're spending or distributing from your accounts to ultimately help you succeed in retirement. So I think one of the things that they might want to look at is, hey, should I delay my Social Security until full retirement age to get that higher benefit that I showed you earlier? And then also I would probably want to encourage them to say, you need to have more stocks in your portfolio. The 100% bond cash feels really good until you get later on to retirement. And then at that point, you could be out of money because you have not been beating inflation over time. So it is very possible for you to be too conservative in retirement because we have to have money in the short term, the midterm, and the long term. That's why I like to build out a 3-bucket income plan, which I have a video that I just put out on that, so you can go watch that to see more about how that works. But having your money assigned to do certain tasks. So you have cash for short term, bonds for midterm producing income, and you can get to within 3 to 5 years. Also, you want to have stocks for that long-term growth bucket so that you're beating inflation over time. We can't discount inflation and the power of it, because if you ask someone that retired 30 years ago how much things cost back then versus how much things cost now, it will be a lot more today. So just wanted to walk through this case study with you, a real life example of what people are telling me, but then also show you, hey, so here's some of the ramifications or negative impacts of what you hope to do and how we can make some positive changes to give you a better, more successful retirement. So if you found this video helpful, be sure to subscribe and give it a like, and then also share it with a friend if they can find it helpful as well. Thanks so much for watching, and I look forward to seeing you again next time.